Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, October 18th, 2024. S&P 500 currently sitting at 58.57. I'm David Zarling. I'm here with our resident Pictionary artist, Ian McMillan. Lots to cover this week. I'm sorry that your team couldn't get you drawing to win the Office Olympics, but it wasn't without trying.
Wasn't. I thought it was, I don't know. I feel like coffee maker is a pretty standard piece of equipment.
Yeah.
But just didn't come through in the clutch.
Yeah, it just happens. I mean, it's a team effort. You can only do what you can do. And it is what it is. But yeah, I mean, Pictionary was a great game. I mean, if you think about it, technical analysis, the visualization of price, a little bit of Pictionary. So giving us a picture of what's going on in this market.
What is going on?
We got all-time highs all over the place. Which
a lot of them.
And that's not indicative, not a characteristic of a bear market. I'm sure you've heard that before.
I feel like, yeah.
If buyers are willing to pay a price that they've never paid before higher, that's called overwhelming demand. And technical analysis is simply the visual study of supply and demand. And here we have all-time highs. Our 46th of the year for the S&P 500.
Wow.
Maybe 47 today. I don't know. But our 46th all-time high.
The first one was January 19th.
Yeah, you could have just said, oh, that's too high.
Or you could have said, all right, I guess this is what happens in uptrends.
Right.
200-day. Market participants are willing to buy stocks at prices never seen before. And 46 times later, we've said the same thing.
It's one of those emotional behavioral levels when you talk about back in January. That 4,800 level was such an important level. The reason being because there was so much selling pressure going back in late 21, 22 that caused the market to correct over 25%. And then move sideways in a 20% plus range. That to clear that level, it's kind of like driving down the road where there's been construction for 6 months and you arrive there this time and all the cones are gone, all the extra stoplights are gone, and it's smooth sailing. Buyers have control. Yeah, the buyers have control. There's a time and a place. You want to observe what price is doing when it reaches those different market mile markers. And in this case, we cleared it, checked back a little bit in April, higher, and now we've got a cluster of 46 new highs for the S&P. And that's not even that egregious. There's plenty of other market examples that we could look at where the clusters of new all-time highs, it goes back to the old adage, new all-time highs beget new all-time highs.
They do. This is how trends work. Again, I mean, if you took something like the index, the Dow Jones, and let's say been around 140 years, and it's just oscillated between 40. I think that the Dow Jones that was the initial, it started at 40, right? I think so. That sounds right to me. I could be wrong. Someone please let me know.
Its initial price?
Yeah.
I'll find out. You go ahead.
But let's just say it oscillated between 40 and 100 for 140 years.
And you were correct. It started at 40.94 points.
Okay.
On May 26, 1896, invented by one of the original technicians, Charles Dow. Go ahead.
So let's say it just moved back and forth, bull markets, bear markets, between, we'll say 40 and 1,000. Then I would say, okay, I mean, all-time highs, probably, maybe a little. But this is how trends work. It's not. We've gone from 40 to 30. No, what are we at now? 43,000 on the Dow?
Yep, 43,193.
43,000. I mean, that's hundreds and thousands of all-time highs over the course of, over a century. That's how it works.
It's the old adage of the same man doesn't step into the same river twice. So rivers operate the same typically, but the man changes and the river changes. And so uptrends are uptrends. Not all uptrends look the same, but they have the same characteristics. They have water. A river has water flowing through them. It has similar rapids. It has pooling. It has consolidation, and then it rapids again. Same thing with markets. There's different bumps and squiggles along the way, but uptrends are uptrends. We have a rising 200-day moving average. We have new highs that were recaptured after the correction that took place in late 21 through 22. We had that breadth.
Your analogy game is on fire today.
That's right. I don't know. Maybe I'm done now.
All right, what else is going on? So S&P, okay, every week we're on here. S&P, new all-time high. Clients pretty bored hearing that. I mean, it's great. And Dow looks good. Not good on Dow hasn't done anything on a relative basis, but it has kept up with the S&P. What about Russell?
And I think you bring up a good point here, though. Uptrends can be boring, but in the honor of the late John Borman, the technician that passed away, he would say, "Shut up and enjoy it."
Got to enjoy it because it will be done at some point. I don't know.
Right. We don't know.
At some point, we're going to go in a 10, 15, 20% correction. But you got to participate.
And to your point, so you talk about all these new all-time highs and things like the Dow Jones, S&P 500. You have major stocks that are making new all-time highs, like Morgan Stanley, and I think you mentioned BlackRock or Blackstone, or
Morgan Stanley, 3-year highs.
Well, it's actually 24-year highs because it was building a base since the late 2000s, and here we are breaking out of a base on base. And to your other point, though, we don't have all-time highs yet in small caps. We're at 3-year highs, but we still haven't cleared that November of what was that 2020 2021 high that took place. It turned out to be a false breakout back in November 21, but we're now approaching those levels. And this is another important market mile marker, meaning just like 4,800 was important for the S&P 500, or just like for the Dow Jones, you wanted to see 36,000, 37,000 clear. We're now in that level for IWM, where we're starting to approach using IWM 243. We're not there. We're at 225. But this is where you start to pay attention to what are buyers and sellers going to do at this level. And when you look across other things like equal weight S&P, equal weight NASDAQ, equal weight several sectors equally weighted, breaking out to new highs, holding new highs, consolidating above new highs. Do we really get to be surprised if small caps do the same? I don't think we do.
I don't know. I mean, even if they underperform, I assume that they will continue to march higher. I'm sure that they will have their, spurts of greatness where kind of just probably enough for a breath thrust. Go back to underperforming, maybe. I don't know. Tech still continues to lag. We mentioned that last week.
Has not made new all-time highs.
No.
It also was up against an important market mile marker on a relative basis using something like XLK versus S&P. We got up to the highest level it had been before was in February and March of 2000. Here we are 24 years later, and it responded to that level with S&P outpacing the NASDAQ, S&P outpacing XLK. So there's some work to do here, and I don't think we get to be surprised. It's going to take some time to chew through supply for tech to reassert itself.
Yeah.
And that's okay.
Apple had a new all-time high this week, right? Or did it kind of stay? Yeah, it stayed up there, hasn't it?
Yep.
Today.
It'll have a new weekly closing high if it stays right here today at 235.
Microsoft. Well, there's a
That is,
big headwind for
yep,
tech.
yep.
That
Google.
it's held in there. It's just sitting on a 200-day, but that relative chart is Microsoft lowest relative levels since April 2023.
Right.
Wow. And that has become the laggard when, I mean, just in July, it was hitting, relative highs. But then we've seen this other stuff, like Netflix continues having a good day today. I guess assume off of earnings.
Well, and that's a name we haven't said on here in a while. Remember when that was part of Fangs? That was, you talked about Netflix. I don't hear anybody talking about Netflix, and here we are at brand new all-time highs.
All-time highs, new multi-year relative highs. Yeah.
Well, and I know that, Snowflake is considered part of that, and that's been a dog, no offense to dogs. But even that is trying to bottom out here. And so do you see a shifting even within the FANG names? You mentioned Microsoft off the highs, Google's off the highs. Now Google's very constructive because it retested the area that it broke above 150. Amazon currently consolidating, not at all-time highs yet. It had been, similar to Microsoft in June and July, and now is trying to recapture those levels now. So the big boys still have some work to do. Like we talked about last week, kind of sitting in the hip pocket of the market, like Pat Mahomes being on the bench and then about to come back in the game. And yet you still have your leaders like NVIDIA leading.
NVIDIA. Yep. Bitcoin.
Oh, yeah.
Bitcoin's trying. I mean, it's there. It's a really pretty chart. I mean, just really primed for having a big day today. So we're back up to 68,000. It's the highest that's been since late July. It looks very primed and ready to go.
Well, what's interesting is, we like to talk about gold and the relationship with gold miners. I find it interesting, Bitcoin versus companies that are related to Bitcoin, like a MicroStrategy or Coin itself. It is interesting to see that dynamic where you could see a scenario where your crypto industry is outpacing the actual asset.
Yeah, and I mean that's where you would, right? I think that would be bullish. We always say it's bullish for when gold miners and silver miners outperform gold and silver, respectively. I assume you could extrapolate that, right? I mean, energy companies usually outperform crude prices when crude prices go up.
Yeah, correct. And so here we have a setup that looks similar to those dynamics where you could see crypto miners or companies that are involved with that industry outpace the actual coin itself, which might upset the crypto maxis, but what do I care? I'm just using ratio charts and trying to tilt my clients in the right direction to be riding on the river rather than up against it or up on a bank. See, I did another analogy. I couldn't help myself.
No.
Back on the horse. Did it again. Anyway, we have Morgan Stanley break out to new highs. You mentioned BLK, BlackRock.
Netflix.
Let's pause on this BlackRock thing. And I might take us on a tangent here, so forgive me. But one of the things that seems to be happening with non-institutional investors is this commentary that Vanguard and BlackRock own everything.
Yeah, for sure. It's been a big one for a few years.
What do you think about that?
And I don't want to get hit by the fine from the FCC, so I won't say anything too vulgar. But yeah, I think it's pretty silly. It's just very, very, very first level, low IQ way to think about, right? And then people show the data, or they show screenshot that talks about, you said Vanguard and how much they own. Usually they try to make it out, usually something along the lines, and tell me if I'm wrong, Dave, if this is usually what you see, something along the lines of BlackRock and Vanguard own 10% of every company in the S&P 500, or usually the S&P, or they'll say every company, or some very big, broad statement like that. Is that usually what you see?
Yeah, in the way it's presented, and I'm going to make two statements. I'll say the negative one first. When anybody says this, that, oh, Vanguard owns all these companies or BlackRock owns all these companies, I immediately want to discount everything else that person is saying, because they're not, like you said, they're using first level thinking. Here's an example. VOO, the Vanguard ETF for the S&P 500, which is invested in by millions of people, maybe even billions of people, through their 401ks, their pension. Those monies travel through Vanguard and buy Apple shares. So it's not Vanguard who owns those shares.
No.
So, for example, right now in VOO, as of September 30th, VOO owns 398 million shares of Apple, valued at $92 billion.
92 billion.
What people are trying to say is that Vanguard owns this. No, they're the custodian. It's inaccurate. It's the way our financial system works. It's actually people's money that are in there owning that thing.
Yep.
And so when people say this, it kind of gets me a little riled up, because it's like, no, you don't understand how this works. And now I have to discount. There's other good things that you're saying, and now I have to discount it because you don't know what you're saying on this topic.
Yeah, I totally agree. It's a talking point that people see and run with because it definitely fits in there. Oh, Wall Street, or like an anti-Wall Street thing, or just these two investment companies control everything that these mega corporations do, as if they're all filling out proxy votes for us, which they're not. Right. You are still a shareholder. I don't know. It's
very unfortunate.
It's very unfortunate, and people see it, and it's alarming. And then they show, like I said, they show these screenshots with big numbers on them. And they're like, okay, well, clearly this person, that's saying this, they've got proof, quote unquote, proof right here in front of me. And then that's it. That's just, oh, I guess, yeah, that's true. They do own a lot of shares. Again, as you said, and through their vehicles, ETFs that they create for individual investors. But it's very naive.
It's a half truth. They're the custodian. That is true. But it's other people and other institutions' money. That $92 billion is individuals. It's other organizations, right? We've owned VOO here in the past. That's our clients' money in there. So it's not Vanguard who owns it. Actually, the really big problem I see with it is some of these people are making really good points about other things, and then they throw this in here, and it immediately causes you to discount the other things that are very truthful. So anyway, I took us on a tangent, but since we're talking BlackRock, I just felt it necessary to address that. So before that, I don't know if you had us directionally going somewhere. Otherwise, we can definitely move you to talk about breadth. You mentioned Bitcoin.
Talking about Bitcoin, I guess all the other stuff in the crypto area looks fine. So I know I just saw a chart a few minutes ago from one of the guys, Sam Gatlin, I think his name is, at All Star Charts. He showed a Solana chart. Looks pretty similar to Bitcoin. Seems like, consolidating below those previous all-time highs. Shout out to Sam. This is the same college my mom went to.
Oh, where did your mom go to school?
Wichita State.
Oh, the Shockers.
Yeah. We can go to, we had an education event.
Yeah.
This week. I mean, when I think about what was discussed there, pretty similar. Clients get a newsletter every month, so they know how we feel.
And they get this weekly
We
trend
get
every
this
week.
every week. There's been very little change of tone for the last. We're really coming up on a year at this point, and we know we shared with them credit markets still very healthy.
Yes.
Explain to them why credit markets are important and how they can give us clues. Credit markets, high yield spreads looked very different late 2021 than they do right now. Definitely, we had a big divergence in 2021. Credit spreads were creeping up along with stocks. We have the exact opposite going on in the current environment. Continue to see risk taking, right? If you have to be in fixed income, high yield bonds moving the exact opposite direction of U.S. Treasuries. You take like a J&K versus an IEF, and very, very strong trend. You want to be in this junky stuff, or investor, and people who buy individual bonds too. We don't buy individual bonds, but they would rather own the junky stuff than hide out in the AAA rated or even U.S. Treasuries.
Right. That's risk on behavior. And the reason why we want to pay attention to this is the global fixed income market, the bond market across the world is about $141 trillion.
That's crazy.
And the global equity market is about 115. So by comparison, bond markets are worth paying attention to. Even when you see treasuries underperforming, we've talked about here in the past that the 60-40 portfolio just isn't viable, especially as we head into a new interest rate cycle where you're not going to get that offset anymore. And our clients are very familiar that when we look at bonds, yes, we look at them as a whole, but then we look at the different slices, the different tranches, and identify where, for example, you highlighted during the education event that T-bills, really short duration. If you had to own fixed income, now T-bills have underperformed the S&P. And in fact, remember, peak T-bill was late 2023, summer of 2023. And if you parked yourself there, you missed out on 40+% from the market. And yet bonds were still down on the long duration side. And so T-bills outperformed AGG, aggregate bonds. You have treasuries that are underperforming, but as you highlighted, junk bonds, high yield bonds, the crappiest of the crap, triple C.
Well, and how about emerging market high yield?
Yeah.
Is doing better than U.S. high yield.
Yeah. So not only is there risk taking, it's out on the spectrum. It's further towards more risk, taking more risk for emerging market high yield, right? If you're buying the crappiest of the crap in the U.S., but the crappiest outside the U.S. is doing even better, what does that say?
It's incredible. Yeah, it's just, again, zero clues. Now, maybe we wake up Monday morning and everything starts going in the opposite direction. Always a possibility.
Oh, absolutely. Absolutely.
I only have the information that we have in front of us today.
Wait,
lots of time.
Are you telling me you don't know the future?
And I was working with a couple of new clients yesterday who were visiting from Florida. We were doing their education. And yeah, we walked, I pulled up a chart of 03 through 06, 07. And, we were explaining why our system doesn't pick tops because, that was kind of a choppier mark. It was an uptrend, but that was not the smoothest uptrend for those 3 or 4 years.
Right.
There's definitely some wonkiness going on there when you look at, compared to other trends. Yeah. 04 through January 04 to May 06. There's a lot of failures and attempted move, and the market does go higher. Definitely moves significantly higher. But how many of those in the moment looked and felt like a top?
You mentioned an interesting period of time. International outpaced 2 times what the S&P did during 03 to 08. And same with things like small caps. So It will be interesting going forward, there will be a day where small caps outperform. There will be a day when international outperforms. And we'll be able to see when that starts to turn using technical analysis. I have no other way to tell that without using a future discounting mechanism like price. And here, have you seen the most recent Economist magazine cover?
I saw either you or JC posted something. Yeah, I saw it. Yep, here's yours.
It's the same one, I'm betting. The Envy of the World, America's Economy, a special report. And on the picture is a bundle of US dollars. And on the bottom of them look like a Starship, a SpaceX Starship rocket. And it's taking off. And wouldn't it be interesting that this marks some intermediate or significant change, not necessarily for the S&P is at a top, but that you start to see international outpace? Because also through our internal work, we saw numerous areas priced in dollars, such as Mexico, and Sweden. So many countries that went out to fresh relative lows this week. And then you get this magazine cover, because the way this works is price moves first, news moves second. You know, we're fond of saying wet streets don't cause rain. Mm-hmm. The news doesn't cause price to move. Price moves, and then the news comes out. And so here we are we on the verge of marking a change towards international? Now, we're not bottom picking that relationship, but you could start to see a turn in international stocks here, or at least be aware of it, because the market is a future discounting mechanism, and typically journalists are not correct. I don't know if anybody's figured that out yet, but typically journalists are not correct.
They've become less and less correct in my lifetime. I'll tell you that.
Yep. And I understand they have a job to do, right? They're trying to sell advertising.
How else will I know to buy a car unless I turn on the local news and watch the commercials?
I won't know what to do. But what news does is it tries to give us a level of certainty, because we can water and feed our own bias garden. And I want you to think about this. So you consume the information from TV and magazines and the internet, somehow thinking that it's going to give you an edge. Do you really think something published to millions of people is going to give you an edge? Because that's not inside information. And I'm not saying you should use inside information, but it's not information that you've analyzed. It's information that someone else has analyzed, handed off to an editor, got it back to the original journalist for refinement, and then published it. And now it's news to everybody, but somehow it's unique to you. Let's not fool ourselves here. The only thing that provides inside information, what investors are truly, truly thinking, is the market. It's kind of like an election. You could take as many pre-election polls as you want and predictions as you want. And Lord willing, you have a integrity in your election system, which I'm open to have that discussion or debate, but it's not for this show. But the best teller is where you place your votes. So where are you placing your dollars? Where are large institutions placing their dollars? That's what matters, not the news cover. That's why we study price. And that was a major theme, again, for our education event, is in our process, we focus on price. Our listeners probably have an idea, Ian, where you and I sit politically. We're allowed to have those political opinions, but it's not going to impact the portfolio.
Well, and like I said last, I was telling, again, the same couple last night, what if you hired us to manage your retirement, help you reach all your goals, keep it protected, and not just keep it protected, but we got to grow. We got to grow accounts. We have to keep up with purchasing power. Okay, and you come to sit with me. You've been a client for 3 years here, and you've just been sitting in a very protective, maybe lots of cash, different types of bonds, just in a very, very protective, conservative stance in the portfolio, because I just didn't like who was in the White House, and I was worried what their policies might mean for the economy and the stock market. And I'm real sorry. Stocks have gone up 80% in the last 3 years. But we just didn't think the stocks were going to do that. Like, I don't want to have those conversations. Clients don't want to have those conversations. So we participate no matter what else is going on until the trend says the game is up.
It's an interesting dynamic because never in the history of the world have we seen so much information available for discernment. And could you imagine showing up at a surgeon's office who knows how to do knee reconstruction and you don't trust them? Or you say, well, actually, we're going to kind of, I'd like to be awake and no painkillers. And the surgeon listened when they know better.
Yeah.
Because they have the tools and the expertise to understand what the risks are for you as the patient. And so they're trying to operate in your best interest. And that's why we use technical analysis to operate in the best interest of our clients. Because in the end, it doesn't matter who the president is, because no party has a monopoly on investment returns, on market returns. We know this. We have the data. And so let us not make decisions based on our own personal opinions. We can vote with our personal opinions on election day, preferably in person and with integrity. But if we're going to sit there and come up with all XYZ reasons that have nothing to do with price, we may end up on the wrong side of the trade. A dangerous, dangerous spot. And like you said, we're involved in markets for protecting purchasing power, not because they're fun or some bias confirmation factory entertainment. It's purely about how do we fund our retirement when we're done working, when we're done with the accumulation phase and we're in the distribution phase where we're going to live our lives and try to take care of our medical bills and take care of our favorite hobbies and do things with our spouse. That's why we're involved with markets. And they're a blessing. But what tools you use to engage the market is really, really important. It's one thing that sets Client First apart is we're purely technical. You can have all the fundamental reasons you want. Shoot, you brought up 2006. From 2006 to 2008, there was plenty of reasons not to be in the market fundamentally, but the market moved 30% higher.
Mm-hmm.
And technical analysis then showed when supply had control of the market, when sellers had control of the market, and you could be in a situation to protect accounts at that time. So I can't brag enough about technical analysis because it's the only information that we have that's current, that's a future discounting mechanism, and 99.9999% of the time doesn't get revised.
Saves me every day.
Yep.
Saves me every day from my wandering thoughts and feelings and emotions on whatever else is going on in the world. And I certainly do my fair share of complaining. Doesn't mean I'm not going to own stocks.
Well, even another asset class, you brought up Bitcoin. You look at the dollar rising, Bitcoin's rising with it, and gold. That's not a relationship you typically see. But as we've highlighted on here before, things go in and out of correlation. And you can have environments where the dollar moves higher along with gold. And most people don't want to think of it that way. They think lower dollar, higher gold, higher dollar, lower gold.
Yeah.
But truth be told, there's times where gold is rising along with the dollar. I don't know what to tell you other than that simple fact. It's just the truth. So we have all these new all-time highs. We have financials doing very well. We have some leaders going out to new all-time highs. We have some leaders that are sitting in the hip pocket, and maybe those are red flags. They could be. The fact that Microsoft's not a new all-time high, Google's not a new all-time high, that could be a harbinger.
It could be. I do feel like we'd see some other things, some other risk on indicators. But again, I mean, I think I said this last week. I mean, outside of high beta versus low vol, There's just not a lot out there. I think David Keller mentioned this morning all the advanced decline lines are making new highs. I don't really care for the term. Don't use it a lot. It's a little jinxy. Maybe I just shouldn't say it. But it kind of, I mean, from a technical perspective, and the things we looked at, kind of a Goldilocks environment.
Okay.
I mean, everything looks fine.
Yeah, correct. And yet the narratives are relatively negative. Like, isn't it interesting how much it was discussed whether we were going to have a soft landing or a hard landing, and people failed to see that the plane is actually climbing and doing very well. Like they completely forgot that the plane was in the air and actually climbing, and we're arguing about a hard landing versus soft landing, and all we've seen is things move higher.
Yeah, I mean, and we don't have things screaming. You know, if we were 15% above a 200-day moving average, that would also be a little.
Oh, yeah, like consolidation would be normal, or
just,
correction.
I mean, look at that Dow chart. I mean, that thing's not even outperforming.
Right.
And it's just comfortably cruising.
And that's an important distinction, because the Dow is highly it's not outperforming, but it's extremely correlated, a little bit more diverse in its sector makeup than the S&P. And then you have something like the DAX, the German index, also highly correlated to US equity markets, also, recording all-time highs and in an uptrend. The weight of evidence continues to show an uptrend is in place. All-time highs are clustering. And is this bull market too old? Like, are we too far along?
Depends on where you want to say. I mean, I guess you can go back to, some people go back to the October 2022, which was the bottom, the lowest we went, using the S&P, and then would measure it from there. Fair argument. There's also the point of view that you wouldn't have a new bear market until you got to an all-time high. So then that moves your time frame up to just what I said earlier, January 19th,
right,
of this year.
So we're sitting somewhere between 10 months and 2 years.
Yeah.
And
how long is the average bull market?
Well, the average bull market's about 5.5 years.
Wow.
And I think you brought this up last week or the episode before, as far as percentage moves. So let's use the more, I'll call it conservative approach. I don't even know if it's conservative. No, the more aggressive approach, which is saying October 22. So 2 years in, as of a week or two ago, up about 64%. When we look at other bull market, from a bear market bottom to a bull market peak, we average about 5.5 years. And at 64% return during that period of time, you're talking about the second lowest return for a bull market using the S&P 500.
Yeah.
And you throw in like equal weight, just clearing highs. You throw in other equal weight sectors that are just clearing to new all-time highs above their late 21, 22 highs.
I think you can also make the argument, so if you use the S&P, you get October 2022. If you use Russell, Russell broke to Russell is breaking to new lows November 2023. So you got to use that as your, and then it was a failed breakdown, and obviously the rest is history, and we've gone up for 50 weeks, not straight, but been in an uptrend for 50 weeks. Value line geometric, I would put that in the same category as that basically went back and touched its. You can definitely make the argument that here's a better way. The broad bull market, I would say, started October 2023. The S&P October 2022.
Yeah, and here you have an environment where a lot of the metrics from an equally weighted standpoint are 0% to 3% return over 3 years. So how old can that bull market be? And secondly, you brought up small caps. We haven't even gotten all-time highs. We're still negative return for 3 years. And you're telling me this bull market is too long? It's something to keep in mind. Like, I don't want to be so bullish that we don't have our heads on a swivel. You always do. You shut up and if you got through the defense, if you're a defensive lineman, you got through the offensive line like a hot knife through butter. You enjoy that, but you're also aware. Is this a screenplay?
Yeah, there just are no other clues yet. I mean, you've got staples, new relative lows, right?
And on an absolute basis, new highs. You know, like,
I mean, I don't know how that's not exactly what you wouldn't want. Oh, healthcare was, I mean, staples do look really bad. Healthcare, new relative lows. Then everything else, financials, industrials, utilities still look okay. And that's fine. We've talked about, hey, utilities were very strong 03 to 07, 08. So definitely some firming up of breath out there as tech, underperforms or is, best case kind of been in line.
And you've got, I was just going to say, you've got Costco, McDonald's, Casey's General Stores, retail. You've got large moves out of airlines and cruise lines. You have Visa and American Express trending strongly. So I don't know that we get to say that the consumer's in trouble.
No. You mentioned Walmart.
I mean, financials holding in strong. There are so many things to like about this market.
Yeah, didn't regional banks get to year-to-date highs this week?
Right. And they're approaching important levels from the Six Sigma event that took place in March of 23 when there was that mini bank collapse. And we're now clearing back above that now.
You're exactly right.
So if that continues, it's going to be another feather in the cap of this bull market. I assume bull markets wear a cap with feathers on it. I don't know. But
I don't know what other kind of cap they would wear.
Right. It just seems appropriate. And those are the types of things you want to see. That's that when you take the weight of evidence and you put it on the scale, those are the things you want to see. Financials doing well. You can have staples in an uptrend, but they're underperforming. It's when staples are in a downtrend or moving lower and they're outpacing the S&P on a relative basis. That's
perfect.
That's the bear. Well, that scenario is a bear market behavior.
Oh, yes, yes.
That's bear market. Whereas moving higher, but at a slower pace than the S&P, that's bull market, to your point. Like, and these are the things we want to be analyzing. You've got credit spreads cooling off dramatically, so liquidity is prevalent. Junk bonds are outpacing treasuries. Emerging market high yield is outpacing domestic high yield. And this is all happening with a rising dollar the last few weeks.
Uranium's back, dude.
Yeah, uranium. Yeah, I mean, I don't know what else to highlight. And I think you used the term Goldilocks. Maybe that's the warning sign. But here's the thing. We're not talking about extended breath here, though. You could have all those things we just talked about, and we've got some extended breath. And what I mean is, if you get a bullish percent of the NYSE or a bullish percent of S&P sitting in the 80s and 90s, okay, now we need to start talking about like buyer exhaustion here, and correlations moving to 1, and are we running out of buyers? And you want to pay attention to that. We don't have that currently. Could that happen after the next 6 months? Possibly. Could we have a pause after the election or a corrective behavior after the election? I don't know. Possible. We're in the late October is still in that volatile period. We've bucked the seasonal trend for the first part of this month. Do we finish October strong? That would be something to pay attention to. Because if we do, how much more bullish does November through April set up in what's notoriously a negative month, October, during an election year? If we don't get that, how much more bullish does that make the 6 months following?
Hmm.
And I'll throw out that, this isn't a jinx it moment or anything like that, but you highlighted some important levels when we look at Fibonacci relationships and extensions. The thesis of 7,000 that you highlighted before still stands.
It is, and people, and the first one. So when we broke to new highs in January, right? We talked about, okay, this measures 5,600. Got there and consolidated for a bit. Yeah. And so we break above that, and now we are on track for 7,000. That is another, 20%.
And most people would think that's ludicrous. Like, this is too far already.
Well, but then how do people think how do you think the Dow got from 40 to 43,000?
Yeah, by going through 41 and 42.
Yeah, this is 43, and then we did that literally for like a whole bunch of times. That is how trends work. I don't know how else to explain it.
No.
If they weren't willing to pay more and more and more, I'd say, okay, well, that's kind of concerning.
Right.
No one wants to pay more than they were in January. Really, no one believes in the market that much. But we don't have that.
The evidence remains. This is bull market behavior. Do we still have 5 or 10% volatility in this market? Of course. That's markets. On average, you have a 10% correction every year. We had a 9% correction in July. Could we see a pullback or consolidation from here through mid-November? Absolutely. Or even further? Absolutely. We're not here to tell the market what to do. We're just here to tell you what the market is doing and the evidence at hand, and use price doing it, the most recent information that we have. And it continues to show hallmarks of bull market behavior, whether people like it or not, whether it's your favorite candidate or not, or your favorite political scene or not, or your opinion on earnings, balance sheet, GDP, you name it. Whatever your opinion is, the market doesn't care about it. And that's a hard fact. People don't like to think that way. They want to think that somehow their opinion matters in the market, and it really doesn't.
And what about this? Okay, so you hate the person in Washington, D.C., or you hate someone that might get elected to be president. One way to offset that is to at least watch her say, well, at least my net worth has gone up by 25% over their time in office. If you can find one silver lining out of it, don't do both. Don't sit there angry and not make money.
Right.
That's silly.
That is silly. Completely agree. So with that, Ian, we're almost to the end of our time, and I want to make sure that I highlight the supporter of this podcast, the Adaptive Select ETF, listed on the NYSE under ticker ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Through proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. Distributed by Quasar Distributors, LLC. Anything else you'd like to highlight for our listeners before we sign off, Ian?
No, I just continue to be grateful that you are participating and making money. It will come to an end at some point, and then we can worry about that. We can cross that bridge when those red flags start showing up, but we don't have that yet.
We don't have that yet. I appreciate your analogies as well. We'll cross that bridge when we get there.
Yeah, it's not like we're going to sit there and write it back down,
Right.
but you guys got to roll over first.
Right. We have to see some evidence of selling first. And typically that type of distribution takes time. We talked about small caps, and before it corrected, you look at IWM, using that as an example. That distribution went from February of 21 through January of 22. It took a full year for that topping process to work. And you could study price and understand, oh, we have some resistance here. We have market participants, institutions willing to sell here. To your point, we'll see that. We'll see that in the data. We'll see that in price, that, oh, this is an important level because price is moving lower. And we can use that to navigate a potential topping process, or maybe it's just a consolidation uptrend. Who knows? But always great to have you on here, Ian. It was great to have you in the office this week and present information to our clients. Very valuable. It's an important part of what we do. So thank you for being here. Thanks for everybody listening. We hope you share this. Give us a high ranking. It's one way that you can compliment us if you enjoy this material.
Great to be here. Have a great weekend, everyone.